In this week's episode, we're going to discuss what risk capacity is and how it will affect your retirement. Some really interesting stuff this week. Let's roll.
Welcome to the Safe Money Retirement Show with your host, certified financial fiduciary, Tim Wood. Tim is a retirement and income planning expert, best-selling author of Safe Money Retirement, Your Game Plan for Success, member of the exclusive Ed Slott Master Elite IRA Advisor Group, and founder of SafeMoneyRetirement.com. Tim uses an education-first approach with clients nationwide to ensure they understand their choices in planning their own safe money retirement. Tim focuses on wealth management, retirement income, tax and long-term care planning, and asset protection and growth strategies. And now, from the Safe Money Retirement Studio in Johnson City, Tennessee, your host, Tim Wood.
Everyone's risk capacity in their retirement is different and unique to each individual person. We're going to discuss what risk capacity is and how it relates to you, and believe it or not, what you can do to actually increase your risk capacity in retirement safely. So we're going to get into that, but first, if you don't already have a copy of my book, Safe Money Retirement, Your Game Plan for Success, I really suggest you get one. We will send you one absolutely free, no charge, no obligation. Just log on to our website, safemoneyretirement.com, or give us a call anytime at 833-413-SAFE. That's 833-413-7233, and we'll get a copy right out to you. Now, risk capacity. First, let's talk about what risk capacity is. Risk capacity in retirement refers to basically the amount of financial risk that you can afford to take with your retirement savings, and it's based on everything, a holistic view of your entire retirement plan. How much risk are you able to take? And it includes different things like what is your time horizon? If you're younger, your risk capacity is much greater because if there's a major market event, or if you go into something risky and it doesn't go up right away, you've got plenty of time to make a correction, a course correction, so to speak. But if you are right at retirement, or even worse in retirement, or even worse late into retirement, risk capacity can be vital because you don't have time to make up losses. Y'all have heard me talk about before the pesky market math. If the market goes down 30%, you need between a 42 and 43% gain just to get back to where you were. So that time horizon is a really big deal when we're looking at everything. But risk capacity in particular is something that people need to think about. How much risk are you willing to take, or even can you take in your retirement? And a lot of that is going to be based on the overall assets that someone has. In other words, someone that's got $5 million in savings has got a heck of a lot more risk capacity than someone that's got $250,000 in savings, so to speak. So that does have something to do with it. But there is something that we can do and that I work with my clients on to help increase risk capacity. Because a lot of people, just because they're getting into retirement, it doesn't mean they want to totally get out of the market or get out of play. I mean, I had a client here in my office just the other day that was talking about penny stocks and how he's going to make it rich on penny stocks. I hope he does. And that's great. Having that risk, though, you've got to make sure that you've got what has to be protected. So what am I talking about? What I am talking about is essentially adding guaranteed lifetime income increases the risk capacity of all your other money. Now, let me explain what I'm saying. So the number one thing that I work with all of my clients on, every single client, every single time, is making sure you've got enough income to last the rest of your life. Y'all hear me preach this every single week. Making sure you've got enough to cover your basic expenses for the rest of your life, no matter how long you and your spouse live. That's the most important thing. So once we have that covered, then the second step typically is we put a couple smaller plans in place to counter inflation in the future. Many of my longtime listeners, you've heard me talk about this too. But then what happens to all the other money? Well, there's some options. And one of those options is once you've got your guaranteed lifetime income set and you never have to worry about having that paycheck. That paycheck is always going to be there. Then you have some more liquidity and some more flexibility and some more ability to increase your risk capacity on your other money because you're not counting on that other money to cover your expenses. Once we know your expenses are covered and you don't have to worry about expenses when you retire, you don't have to worry about expenses 5 years down the road, 10 years down the road, 20 years down the road. Once you know that that is off of the table, that takes longevity risk off the table, that takes market risk off the table, that takes all these risks off the table, then that opens you up to be able to do what you want to do and open up that risk capacity on other money. So let's throw some real numbers out there. Let's say someone's got $500,000 in their IRA and they retire. Well, we look and we determine that, let's just say they need $250,000 of that in a guaranteed lifetime income plan. That between that and Social Security is going to cover what they need for income when they retire. Then we may take another couple, 50,000 here and 50,000 there, and do them in a couple smaller income plans that can continue to grow, that can be turned on in the future to hedge inflation. But that still leaves 150 over here. Well, what can we do with that? Of course, there's safe things we can do. We can put them into a safe growth product that's got a set rate, that has no chance of losses or whatever. But for some people, they still want to have the chance to hit it big, so to speak. They still want to have that risk, that thrill of knowing that, you could hit the next penny stock. You could hit the next one that blows up. Okay, great. As long as you have got what you know you've got to have to cover your retirement, the rest can almost be play money. You can increase the risk capacity on the rest of your money as soon as you know the expenses and the money that you've got to have. Your expenses will be covered by the money that you've got to have. And here's how we're going to cover that with guaranteed income, not if come, and boy, I sure hope I'm going to be able to do it. Guaranteed income, once we know that's done, and once we know there's an inflation hedge in place, and we know all of that is taken care of, that opens up the rest of the funds to do whatever. It could be in a safe product with me in some sort of a growth plan. It could be in a long-term care thing. It could be in a life plan, so a legacy when you're gone. It could still be in the market. It could be in penny stocks. It could be in bonds. It could be in T-bills. It could be in whatever you want. But it gives your risk capacity that much more that you can afford to risk, knowing that you've got your guaranteed income covered, knowing that you've got an inflation hedge in place, and knowing that no matter what happens, your expenses are going to be covered. That is the most important thing, and that's what's going to allow you to increase that risk capacity as you move into retirement, knowing that you've got that extra money that you can do whatever you feel you want to do with, play with it, do whatever you want to do. It will allow you to increase your risk capacity while still having a safe money retirement. Golf and retirement can be a lot alike. I am having a terrible time this round, and it has been rough. And you can have those days in retirement, those days when you get up and you see the market has tanked and you feel it in your stomach, and you've worked 20, 30, 40 years to save what you need for retirement. Well, what if you could absolutely 100% protect what you've saved and not have to worry about market losses anymore? What if you could have enough income for you and your spouse for the rest of your life, no matter what? Hi, I'm Tim Wood. I'm a certified financial fiduciary, and I wrote Safe Money Retirement, Your Game Plan for Success, to give you a guide map in order to protect what you've worked your whole life to save. See, my father lost over 75% of his retirement in his first 4 years because the market crashed. Don't let that happen to you. Download your free ebook now and get the answers that you need. In this week's case file, we're going to discuss the story of Joel and Shawna. Now, Joel and Shawna, great couple. Joel actually had just retired when he came to see me. Shawna actually had retired a couple of years ago. Their situation was Joel was still deferring his Social Security, which we always recommend. Joel was, by the way, I should say he was 67. We always recommend for the higher earner to defer Social Security as long as possible, but it's because, of course, the spouse is going to get that as a benefit if the higher earner passes first. So we always recommend that. So that's what Joel was doing. He was deferring Social Security. She had already turned hers on. But what we were doing is we were looking at moving forward. So over the next 5, 10, 15, 20 years, what was their income gap going to be? The income gap is essentially the difference between how much expenses you have and how much income you have. If you've got more expenses than you've got income, you've got an income gap. And they had an income gap for the next 3 years because he wasn't going to be taking Social Security. So what are his options? We looked at several different things, and we actually came upon an overall plan. What that plan consisted of was actually 3 different products. The first product was a product that we put some money into that was just going to pay him for the 3 years, essentially a bridge to get him to that Social Security age. So it covered the expenses, but it was just to Social Security, and then once Social Security kicked in, that one was done. Then we also had another plan that was going to defer for 3 years that was going to start along with Social Security that actually would kick his income up a little bit then. And then there was a third plan that we put in that was just a smaller income plan. That's just a long-term plan that he doesn't know when he's going to turn it on. It could be 10 years, 15, 20 years down the road. It just keeps growing until he turns it on. So by the time they left, they knew they had a plan to where they were going to have enough money between now and when he was turning on Social Security in about 3 years. Then they had a plan once he turned on Social Security to also turn on this other income plan. So that actually kicked up their income some. Then they had a third plan that's kind of a backup plan that if they ever needed a little more money in the future, it's kind of like an inflation hedge. They left here absolutely ecstatic, knowing that they had their expenses covered for the rest of their life, no matter what happens. They were completely thrilled, and thrilled clients makes a thrilled fiduciary. Now, how can this relate to you? Let's say you're in a similar situation. You are thinking about retiring, but you're trying to defer Social Security for as long as you possibly can, because we all know you get those raises essentially in Social Security for every year that you defer and don't turn it on. So what you can do is we can look at a plan that's only a set number of years. So what I was talking about for him, he came in, he had 3 years between when he retired and when he wanted to turn on Social Security. He wanted to turn on Social Security at 68 and he was 65. So what we did is we basically got him into a plan that was going to pay him only for 3 years, not a lifetime plan, just a 3-year plan. Obviously it needed a whole lot less funding because it was just funding those 3 years, but it was funding those 3 years on a guaranteed basis. So we got that taken care of. Then we did another plan, and this is exactly what we could do for you for when you do turn on Social Security. Well, what do you want your total income to be? Well, let's figure out what your Social Security is going to be, what your spouse's is going to be. Now, do you have any other sources of actual guaranteed income? Rental properties, pensions, things like that. Things that are guaranteed income, not assets that you're pulling from. That's IFCOM. Figure out what that is, figure out what your expenses are, and now let's figure out how much extra do you want to have every month for your play money, for your play checks, as y'all have heard me call them before. That's what we did for them. So once he actually turns on Social Security, that's going to kick on. And then that last plan, that is basically a hedge for inflation. So we can do smaller plans, and those smaller plans, they just keep growing. Every single year you don't turn them on, just like Social Security, they keep growing. But for some plans, they don't ever stop growing. They just keep growing and keep growing and keep growing. So at some point in the future, you can turn that on when you need some more money. Or worst case scenario, if you never turn it on, then it all goes to your beneficiaries. So putting this together, again, y'all have heard me say this over and over, making sure you've got enough income to cover your expenses is absolutely the number one most important thing that you can do, and something that you can work on with your certified financial fiduciary to make sure you've got the right plan. Well, I'm about out of time, and I would like to thank you for listening to the Safe Money Retirement Show. If you're serious about your financial future, give me a call and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market loss. Thanks for listening, and until next time at the same time, I'm Tim Wood reminding you to stay safe so you can step into a secure future.
You've been listening to the Safe Money Retirement Show with your host, Tim Wood. Find out how to contractually guarantee that your income in retirement is guaranteed lifetime income and not if-come. Avoid any future market losses, plan for the potential of long-term care, and make wise tax planning choices so you can have the retirement that you deserve. Call us now for your free copy of Tim's best-selling book, Safe Money Retirement, Your Game Plan for Success. Call 833-413-SAFE. That's 833-413-7233. Or log on to our site at safemoneyretirement.com for more information or to request your free book. Thanks for joining us. We'll see you online at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Obviously, by contacting us now, you are only taking the first step toward protecting your retirement. No information presented today should be acted upon without meeting with a qualified licensed insurance professional. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Interest and other guarantees in annuity contracts are subject to the claims-paying ability of the insurance carrier that issued the contract. The tax consequences of annuity income should be considered with the help of a licensed tax professional. Rates and returns mentioned on this program may vary based on state availability and are subject to change without notice.